Okay, we're now up to 14 and we really have quite a packed session. So I'm going to go ahead and introduce. Surely during the introduction, we might get some more people joining us, but it allows us to start. So welcome to this webinar on the accounting principles that are relevant to the pay-as-you-go sector. This work has come out of the work on the KPIs, the key performance indicators, the metrics that as a sector we've come together to define. And in doing that work, it was immediately apparent that accounting principles were essential to an essential context. We had to make a decision on what basis the metrics could be calculated, and we've done that. But it was an immediate issue to take that additional step and look at least at the accounting principles so that anybody using the metrics would be better informed, and we as a sector could develop a position on how important or otherwise consistent and standard accounting guidelines should be. So this work has been supported, this webinar in particular, the work on accounting guidelines has been supported by the IFC, by GOGLA, the industry association. It was performed by MFR, a rating agency specializing in financial inclusion. I'll introduce Lucia and our other panelist, Brian, shortly. To just give this a little bit of context before we move into the session in particular, I think that the experience I had in preparing the first accounts for a pay-as-you-go company was that the local accounting context was not at all clear. That was a learning process in itself. And the challenge of making sure that I communicated not only performance, but the correct accounting to reassure investors turned out to be, an essential part of what I was doing. And until we arrived at a position, it created a lot of uncertainty. And that has the potential to undermine trust. So there is no doubt that perhaps when you start, you're focused rightfully on gaining customers, on building the company. But very rapidly, as your need for funding rises, you have to create a solid foundation of trust. And the KPIs are a particular part of this. And we really do see the accounting guidelines as, or this webinar, as the essential next step. So with that, I would like to just introduce Lucia, who's going to present the webinar. Lucia is an innovation director at MFR. This is an agency specializing in financial inclusion, as I said. She has already worked with us extensively, her and her team, on the KPIs, on the impact monitor that we did, and now on this. And I would point out that Lucia is not just supremely technically talented, but is well grounded in the field experience, which we all know makes a big difference to how we approach this work. And she's joined on the panel by Brian Chege from Sunfunder. He's a senior analyst with Sunfunder, extensively experienced in lending and making those tough decisions about what the numbers mean, what are the risks associated with it, and then taking the investments decisions associated with that. So Brian is also supremely well qualified technically, and indeed has that background not only of accounting, but actuarial science, which always intimidates me. So Brian, we're looking forward to your contributions. With that, I hand over to Lucia and we can get straight into the webinar. Thank you so much for joining us today.
Thanks a lot, Kevin. When we piloted the calculation of the KPIs, calculating the KPIs themselves was the easy part. What was difficult, and the colleagues from PAYGo companies may agree with me, was to understand the building blocks that are needed to calculate those KPIs and how they are constructed based on the accounting standards adopted by the companies. That was difficult because accounting standards do vary a lot across companies. And this poses a challenge because what this implies is that the revenues, costs, outstanding receivables, and credit loss provisions are recorded in different manners across industries, across companies, which does affect the portfolio quality, financial performance, company and operational KPIs, which is the object of our call. I invite you to please download the full PAYGo accounting brief from the link that colleagues will kindly put in the chat box, because today, unfortunately, our time is limited. So this accounting brief is meant to shed some initial light on the differences in accounting policies, how they impact on the PAYGo perform KPIs, and it is meant to be a very first initial step in a potential journey towards greater transparency and harmonization of accounting standards. There are several benefits that can be gained in such a journey. One clear is the accuracy and comparability in PAYGo perform KPIs, but benefits go beyond this. Harmonized accounting practices would make it easier for funders to review companies' financial statements and to do due diligence. This is especially true for non-specialized investors that are essential for the growth of the sector. Until we get there, and at a minimum, transparent disclosure of accounting policies is of great help. Also, PAYGo firms can adopt transparent financial reporting in line with internationally recognized good practices, so that managers and board members can make strategic decisions based on a better understanding of the company financial health and reliable benchmarks. And there is also another point which is an important benefit for firms in managing and reducing the potential misalignment when existing between the nature of the transactions, being it sale or leasing, the language that is in the customer's contracts, the accounting standards used to produce the financial reports, and the legal status of the firm. Because clarifying this would help manage the potential regulatory risk arising from the fact of carrying out leasing activities in practice without necessarily being incorporated as a leasing company. This is what the brief attempts at doing. One thing this brief does not do is to prescribe one specific accounting standard. To use the words of a colleague at a PAYGo company, it is hard to require a certain accounting standard, but there needs to be awareness of the different standards available. As long as the accounts are IFRS, they are valid, but the choice of standards changes the picture significantly. Brian, what is the value of the accounting brief in your view?
Thank you, Lucia. Well, it certainly is useful to, or very helpful to be able to compare with apples. So this accounting brief is very helpful in providing a high-level view to investors on the impact that potential investee companies' accounting policies will have on their financial reporting. Recognition policy and linking that to the cash flows is handy for lenders, especially if they don't have so much experience in investing in the sector. And in the long run, this would actually encourage more lenders and more even equity investors to get into the space. So it's not only useful even for investors, even the companies themselves can use this accounting brief to benchmark themselves against their peers.
Thanks, Brian. Before we proceed, let me do one important thing, which is to thank sincerely the companies that made this process possible by sharing their practice, challenges, and views on the accounting adopted in their structures. This work is based on workshops that were made with representatives of 24 PAYGo country firms in 2020, the review of audited financial statements of 11 PAYGo country firms, followed by follow-up interviews with representatives of 10 firms. I keep on repeating PAYGo country firms because it is important to keep in mind that the object of this brief is the firm that is incorporated in the country of operation, which is the place where the transactions are recorded. Also because companies belonging to the same holding may adopt different accounting standards depending on the different countries. With this, let me move to a question to you regarding revenue recognition. Based on the standards you use, the standards you have seen being used, the standards you believe should be used, how much revenue should a PAYGo firm recognize in the year 2021 for the following transaction? A unit is sold on 1st of January 2021 under a 2 years PAYGo contract for a total value of $250. The cash price of the same unit is $150 with the following breakdown. $50 paid upfront, and then follow-on payments scheduled for $80 in 2021 and $120 in 2022. You have multiple answers available, 250, 200, 130, I do not know. Few more seconds. All right, let me temporarily close. So it is interesting to see that the majority would recognize $130, closely followed by 250, while among those who would like to give an answer, $200 is the answer that received the least responses. Thanks a lot. So the good news and the bad news at the same time is that all answers are true and they are all possible. They simply depend on different accounting standards, and to use the words of a PAYGo colleague, before doing any analysis, you should ask which revenue recognition method is used. Brian, what has been your experience with revenue recognition and outstanding receivables?
Thank you, Lucia. So generally what I've seen is that depending on what stage of growth a company is in and how long it's been in existence, the most common thing I've seen is to follow IFRS 15. Normally when companies are starting off, they usually recognize the full revenue, but then with time, they eventually switch to IFRS 15 just so that they can better align their income statement with their statement of cash flows, because it's very confusing sometimes. You see large revenues and negative cash flow. So you ask what's really going on. And this usually helps, especially when aligning debt and equity investors. Something else that is also very rarely mentioned is the influence of tax authorities. So you'd see tax authorities prefer full revenue recognition upfront. So because it usually results in higher profits and higher taxes for them. But generally, our own preference is to align more with the cash flows, given the subjectivity involved in revenue recognition. And that is in my capacity. I'm speaking in my capacity as a lender. Yeah.
Thanks, Brian. Very interesting. Right. So it is interesting to see that actually the response that received the least answers is actually the case that we see more often, which is the adoption of IFRS 15. In the example that we saw earlier, to relate to that outcome, the 250 response corresponds to the full upfront recognition of the total value of the contract, $250. This is the case, as Brian mentioned, of financial reports prepared not necessarily following a specific IFRS. The income recognized in the initial period starts decreasing when companies use IFRS 15 or equally IFRS 16 finance lease. Here, the logic is to recognize upfront the product income, which is equivalent to the cash price of the same unit, and to recognize over time the finance income, as in the case of IFRS 16 finance lease, as the income accrues over time. The revenue recognized in period 1 is even lower in the case of IFRS 16 operating lease, where the recognition is based on the payments scheduled in a given period, and so much more similar to the expected cash flow than in the other cases. This is one piece of the diversity. Opinions differ in the sector, ranging from it would be bullish to recognize 100% of revenues upfront. Your costs may be front-loaded, but they will never be 100% upfront. Going to IFRS 16 operating lease isn't perfect, but it correlates better with the costs and benefits of the business. In addition to this, you do see within IFRS 15, which is the standard that is used in most of the companies, followed by IFRS 16 finance lease. So within IFRS 15 firms, you do see differences in the breakdown between product income recognized upfront and finance income recognized over time. IFRS 1561 is very clear on what product income is. And this is the price of the unit if sold cash. Crystal clear. Problem is when such cash option is not available, and there needs to be an estimate of what that cash price would be, which does introduce some space for interpretation. You do see across companies in applying IFRS 15 differences in the product and finance income breakdown, going from a 50-50 balance up to a 70% product income and 30% finance income. So with different distributions of recognition of revenue across time. One piece of this is very objective, and it has to do with the different terms. The longer the term, the higher the finance income share, or they may relate to the concept of term, being it contractual, which is according to IFRS 15, or effective, which is even more prudential. And then there is this aspect of estimating the cash price, which also may play a role. And this leaves room and space for opportunities of consulting in the industry and potentially adopt common criteria for comparability based on benchmarks of products sold cash. The differences in revenue recognition are precisely the reason why revenue was not, unfortunately, an option to be used in the financial performance KPIs of PAYGo Perform. And instead, cash flow was chosen as a second best until higher harmonization is achieved in the industry that will allow to go back to the normal, which would be to use revenue in the financial indicators. Some of the company and operational KPIs do use revenue, though. These are the sales model, sales distribution model, and percentage country sales. So these KPIs technically are affected by the amount of revenue that is recognized depending on the standard, being it higher when no IFRS is adopted, intermediate when either IFRS 15 or IFRS 16 finance lease are adopted, or lower in case of IFRS 16 operating lease. However, the margins of lower comparability are considered tolerable and not to dramatically distort the picture given the nature of these KPIs. One area where there is a risk of substantial margin of non-comparability is the recognition of the cost of goods sold, which is similar in the case of no IFRS, IFRS 15, or IFRS 16 finance lease, but is deeply different in the case of IFRS 16 operating lease. We have already seen that revenue is recognized gradually over time. Likewise, the cost of goods sold in the case of IFRS 16 operating lease is also recognized over time as opposed to be recognized 100% upfront, because the value of the units is capitalized and it stays on the balance sheet of the company as opposed to being sold or financially leased to clients. It is the concept of an operating lease, and it is gradually depreciated over time, which means that the cost of goods sold, just like revenues, is spread over time, which improves technically the EBT margin, contribution margin, cost of goods sold ratio, liquidity, and unit contribution margin, any KPI that does use the cost of goods sold as one of the building blocks. To manage this situation, the recommendation is, in the case of companies using IFRS 16 operating lease, carefully consider the effect of the recognition of costs in the analysis and in the benchmarking of the KPIs. So you may ask, all right, but I'm confused by now. On which basis should a company determine what accounting standard to use? This is the theory. The theory is very clear, and based on IFRS, the accounting standard to be used depends on the nature of the transaction as described in the contracts to customers. Namely, is the ownership transferred? Yes or no? So is it a sale, or maybe the ownership is transferred over time, which would be a financial lease, or maybe the ownership is never transferred, which is an operating lease. Plus, in the case of PAYGo industry, which is about small amounts, IFRS 16, so lease, allows companies to go back to IFRS 15 if they wish, because of the small amount of transactions. This is the theory. Now, the practice, as a colleague from a PAYGo firm correctly points out, is that even a small sentence in the contract can change the IFRS applicable. So let's take a more pragmatic approach and see the pros and cons of different standards from the perspective of a PAYGo firm. IFRS 15 and IFRS 16 finance lease are similar in some ways and mechanics. However, the essential difference of 15 being about sales and 16 being about lease does have some important implications. The IFRS 16 operating lease is the one standard that allows to spread evenly over time revenues and costs, unlike IFRS 15 and 16, which are much more front-loaded. IFRS 16 operating lease, and to some extent also IFRS 16 finance lease, present more advantages than IFRS 15 in terms of VAT, because both the amount and the timing of VAT payables are lower in the case of IFRS operating lease. The full amount of the contract is invoiced under IFRS 15 the day you sell the unit. On the other end of the spectrum, you have IFRS operating lease, where invoices are issued, say, on a weekly basis. And this is when, and for those amounts, VAT becomes payable, with clear advantages, of course, in case of default of clients. Same goes for the credit loss provision basis. The outstanding receivables are very different in those depending on the standards, and the basis for provision calculation is much smaller in the case of IFRS 16 operating as opposed to the other two. However, IFRS 15 does have an important advantage, which is the one of not presenting any ambiguity when it comes to regulation. IFRS 16 is the standard of leasing companies. Leasing companies are usually regulated under financial regulation. So in some cases, potentially, IFRS 16 may contribute to raising the question of why a company is conducting leasing activities without being regulated as a leasing company. As Brian was mentioning, it is also difficult to deal with local authorities, and there are sometimes different incentives when it comes to standards adopted by PAYGo firms. On one hand, tax authorities like IFRS 15, because this means higher VAT, higher revenues, and potentially higher profit taxes, while they usually see with some criticisms provisioning as a way to decrease revenues. On the other hand, regulators may favor instead IFRS 16, which results in more prudential revenue recognition and stricter provisioning policies. So the conclusion is that there is no clear-cut conclusion for now. IFRS 16 finance lease does resonate with the nature in practice of many of the lease-to-own operations that are carried out. At the same time, it is possible that some of those leasing activities may follow under regulation in the future. None of the companies currently adopting IFRS 16 finance lease are regulated under financial regulation as we speak. However, regulatory frameworks are evolving in emerging countries. At the same time, IFRS 15 always remains an available option when we do sales or even when we do leasing because of the small amounts of transactions. And accounting is one of the many things that is in constant evolution in PAYGo firms. So you may see cases of international groups willing to converge towards IFRS 16 finance lease. You may see other international groups more interested into a combination of standards moving forward. One thing that is clear is that industry harmonization is unlikely in the medium term. And so until at least the medium term, it will be very important to be aware of the financial reporting standards used, their implication on the KPIs, and how to look at them in a comparable manner. Let us move to outstanding receivables. And I have the same unit for you that we saw before. So the unit that today a customer buys, paying an upfront deposit of $50 under a 2 years PAYGo contract for a total value of $250. And the cash price of the same unit is always $150. What is the amount of outstanding receivables that I shall book today? You have as available answers 200, 150, 0. I do not know.
Don't be shy. Quick click will help us a lot.
All right, so okay, let me close now. The most common answer is $200 US, and so the full outstanding receivable followed by 150. Again, good and bad news is that all of those answers are possible. It simply depends on the IFRS used. 200 is what companies using no IFRS or IFRS 15 would book. This is the full trade receivable, the full price of the good minus the down payment. The outstanding receivable is then the net lease receivable in case of IFRS 16 finance lease, which is the future cash flow net present value as of today using the interest rate implicit in the lease. While the outstanding receivables is even lower in case of IFRS 16 operating lease, and it is only the amount of invoices already issued and not paid yet, so delayed payments. Majority of companies still uses IFRS 15 or 16 finance lease. Clearly, this would have an enormous impact on the portfolio quality KPIs. You understand that if we used the outstanding receivables as per financial statements, RAR 30 would be completely uncomparable across firms. So what is recommended here is to recognize that and anticipate that the amount of outstanding receivables that investors will see in the financial statements will not necessarily be the same amount that is used according to the PAYGo perform definition to calculate the portfolio quality KPIs. That amount is the one that shall be extracted from the operating system, and that corresponds to the full trade receivables under IFRS 15 or no IFRS, plus a reconciliation between the amount investors can see on the financial statements and the amount used to calculate the KPIs may always help and increase trust in investors. Brian, what have you seen on provisioning policy and credit loss reserve?
The most common thing I've seen is very simplified IFRS 9 provisioning. So most companies tend to have just a general assumption on the whole book. Say you say 10 to 15% of your outstanding receivables are lost over time. So that's what you do as your provision for the whole book. But then as IFRS 9 has evolved, we are seeing more the need to have that general provision and then also have specific provisions. So in a nutshell, most people usually do partial IFRS 9 provisioning, but right now moving towards full IFRS 9.
Right, thanks, Brian. Indeed, majority of companies are seen to be implementing or being in process of implementing IFRS 9 simplified approach. Some implement IFRS 9 general approach to calculate credit loss provisions, and some do not implement IFRS yet. IFRS 9 is a recent concept, relatively, and one thing that is important to consider is that differences in the amount that is provisioned may come less from the choice of IFRS 9 simplified or general approach, and potentially more from the assumptions used in provisioning. So what probability of default is associated, according to the judgment of the company, to the different risk categories. You may see some companies using receivables at risk defined based on consecutive days unpaid, other companies using collection rate, others using a combination, others using different concepts. And, you know, in some cases, you may see, for example, receivables at risk late 30 to 60 days being provisioned anything between 30% and 50%. In different companies, depending on the company judgment on the probability of default for that range. Similarly, you may see that one company provisions more for receivables late 120 than another company provisions for receivables late 180 days. So assumptions do matter a lot. Plus the receivable basis, which is very different in the case of IFRS 16 operating lease with a small amount of trade receivables and a large lease asset. These differences impact the provision expense ratio and the unit provision cost. To employ a PAYGo perform colleague, quote, provisioning is notoriously judgmental, let's recognize, and it can only prove sufficient at the end of the contract, which is the reason why we recommend that potentially, in addition to those KPIs, some considerations may be made in terms of risk coverage. What is the loan loss reserve, not the cost, but the accumulated reserve I have available against what is the amount at risk, defined in different ways. And regarding write-off and revaluation policy, Brian, what is it that you have seen?
I'll just piggyback off what you said. There's a lot of subjectivity in terms of the assumptions that are taken. So when do you actually do the write-off? That's usually the biggest question that I've seen asked by some of these PAYGo companies. Some would write that have not been repaid for 90 days, some 120 days, some even 180 days. The most common thing that I've seen is between 90 and 120 days, and most people are converging at around days. Even in my own experience, just analyzing several different companies, I think it's very safe to say anything over 60 days is highly unlikely to be repaid. And once you get to 90, it's most likely not to be repaid. So such kind of decisions and justifications behind such assumptions are the biggest things that I've seen.
Right, that's an interesting debate. Thanks, Brian. Indeed, write-off is something recent in the PAYGo sector. It is becoming more frequent, even if the cases where this is done systematically are still a minority as we speak, but there is a movement in this direction. Indeed, concepts range. So IFRS 9 determines that it is up to the judgment of the company to define default. There is a rebuttable presumption that financial assets late more than 90 days are at default unless the company can prove that the dynamic is different. So what indeed it is seen is consecutive days unpaid more than 90, 120, even 180. In some cases, when write-off is not systematic, there is even receivables more than 1 year late still on the books, but it is a process that is ongoing. Collection rate is also an interesting parameter, or combinations of consecutive days unpaid and collection rate. What is always the case in the companies reviewed is that the amount that is written off is the unrecovered amount. And so the difference between the outstanding receivables at the moment of repossession, when it is possible to repossess a unit, so the difference between the outstanding receivables and the value repossessed minus administrative costs to do the repossession. With this, let me conclude regarding write-off and revaluation to say that the different assumptions and policies adopted by firms, maybe more than IFRS 9 or no IFRS 9, have some impact on the write-off ratio and the repossession ratio. And because these two KPIs are clearly complementary, because write-off is after repossession, there may be some advantage in analyzing them jointly in addition to individually. One thing we'd like to point out is that for companies using IFRS 16 operating lease, the numerator of the write-off ratio should not only include the amount of trade receivables written off, which is the small one, but also in their case, the amount of stock written off for the same clients being written off, because the items are R2 in the case of companies under IFRS 16 operating lease. Possible next steps. This is an industry that needs to grow. To do that, we need investors' trust, and not necessarily only specialized investors. To be able to do this, and given also the importance for strategic decision making at companies, it is paramount to, at a minimum and in the short term, disclose in a transparent manner the accounting policies used, and to the extent possible, consider in future ways to harmonize the ways accounting practices can be disclosed, and to the extent possible, harmonize the accounting standards themselves so that over time, the industry can be made more transparent and attractive for a wide range of investors. Bill, over to you.
Thank you, Lucia, very much for the very informative presentation. And thank you, Brian, for your very useful comments and insights from the sector. We are now moving into a Q&A phase. So we've noted in the chat, but for people who haven't seen it yet, you can submit your questions in the Q&A section on Zoom, and we'll you know, give Lucia and Brian a chance to respond to them as they come along. I don't see any questions that have come through just yet. So we'll give people a couple of minutes or a couple of seconds to enter some. In the meantime, we had teed up one question for Brian that we thought would be very interesting to get his perspective on, which is, you know, this question about next steps and going forward. What do you see as the benefits of harmonization in the sector as it matures and as it moves ahead?
Thank you, Bill. I think the most beneficial thing we'll see from harmonization is we'll see a lot of interest, way more interest from investors, and also alignment between the investors. So something that I've seen in my own experience is that debt investors generally look for path to repayment, and equity investors generally look for profit. Divergent views and the divergent revenue recognition policies, for example, it is actually quite possible that you could find debt and equity investors in the same company or in the same investment having very different views on not actually being aligned. But we have harmonization as to the how revenue is recognized, how this reflects on the cash flows, what is the provisioning methodology that is most useful. Then you'll find there'll be more agreement between equity and debt investors. There'll be more debt investors, there'll be more equity investors, and the end result of that is just growth of the sector, because I still think there's a bit of fear because of all this uncertainty and subjectivity within the PAYGo space.
Thank you very much, Brian, for that. And I do see that we've gotten a couple questions in. This first one is from Ross Thompson. So would it be possible to discuss the deferral of revenue under IFRS 15 and then a little additional clarification? I understand that full revenue is recognized and then a deferral and related liability are recorded. Is that correct? Why not just record the net amount of revenue? I think, Lucia, this is probably more directed at you.
Thanks a lot. Very interesting question. So as you can see on the screen, this is a representation of that same unit of the poles and how it gets recorded. So let's focus under the different standards. If we focus on IFRS 15, we do see that there is a gross revenue of 250 that is decreased by a financial income discount or deferral of finance income. You find this more often as a contra asset actually than as a liability, but yeah, contra asset would be preferable, not to inflate the balance sheet. And so the difference between the gross revenue, which is the full amount of the contract, and the finance income discount or deferral is your product income that you can recognize upfront, which is indeed the one that summed to the finance income accrued in this period is equivalent to the 200 full revenue. So you do, if I understand well your point, thanks otherwise for clarifying, you do technically recognize the net only for the purposes of your bottom line. However, it is also important to report the gross in your statements for transparency, for trend analysis, and this is according to IFRS 15.
Thank you very much, Lucia. I don't see currently any additional questions from the audience. Let me just double check that. Yeah. So please just a reminder everyone that there's a Q&A chat at the bottom of Zoom that you can enter them in. But if we don't get any, I will go ahead and raise another one myself, which is for both of you, Lucia and Brian. Thinking about potential harmonization, but also just sort of, let's say, standardization and professionalization of accounting practices in the sector. What do you see as the challenges for firms in terms of capacity and building that capacity to actually implement some of these things? These can be relatively difficult questions for people who aren't really well trained in them. And do you see that there's sort of a capacity gap on the ground? And I haven't prompted this beforehand, so apologies if I'm sort of putting you on the spot, but can you think of any resources or tools or steps that firms could take to try to build that capacity and strengthen it to achieve some of these goals, besides, of course, downloading and reading our accounting brief, which we have shared the link to, but we will also share after the session.
Thanks a lot, Bill. Brian, if you agree, ladies first.
Sure.
So that's a very good question, Bill. I would say the financial reporting capacity, like many other aspects, differs a lot across firms, small versus large, potentially receiving help from an international holding or not. So you do see some differences in the capacity to make the good choices and to implement those standards. I would also personally dare to say that the investment into IFRS and financial reporting should be commensurate to the size of a company. And so it is normal to start no IFRS or IFRS 15. And then as the company grows and it can absorb the cost of professional CFOs, then it is really a decision of the company on which IFRS is to be implemented. It is not rocket science, but this is a decision that impacts the results and may also depend on the risk appetite to regulatory aspects of boards. You see companies operating in the same country having very different views on the regulatory risk implied by the adoption of an IFRS standard.
Thanks, Lucia. Brian, any thoughts on this?
Yeah, so another angle I want to bring in is a lack of capacity from the accounting or finance systems side of things. So a lot of these companies have off-the-shelf systems or computer systems, or they just hire people who come in and develop their own systems internally. And the most common thing that's there has been IFRS 15. So when it comes to having an overhaul of your whole accounting system, reporting system, it can actually be a big cost. And although it can be really difficult if you're relying on, say, an internal team, and you just find sometimes some of these companies prefer to stay with the full revenue, the full upfront recognition, or IFRS 15, just because it won't upset their whole cost and their whole system. So there's other aspects as well.
Great, thank you. And that's a really important point. I think that probably we don't think about that much. It's just the logistics of this can be somewhat challenging too. I think we have maybe time for one more question from our colleague Drew, which is basically what can we learn from how the MFI space is regulated that can be applied in our sector? Lucia, would you like to take a first shot at this? I know you've worked a lot with the MFI sector.
Thanks, Drew. That's a really good question. There are things we can learn. There are things it is harder to learn. One thing I would say is be prepared for regulation. And, you know, in some cases being also already adopting some self-regulation discipline and prudential international good practices in some cases may help reduce the risk of regulatory overreaction that is sometimes tailored to the sector in part, and in part it is not. One thing that helped a lot the microfinance institutions sector in the late 90s, early 2000 was the publication by CGAP of the disclosure, financial reporting disclosure guidelines, which was a milestone in providing some guidance on how financial institutions could report the specifics of microfinance to external parties. This can possibly be a next step if the industry is willing to go in this direction. What we may wish to avoid, if possible, is overreactions of the type of setting price caps, for example, and other rigid regulations that unfortunately are sometimes more political than beneficial for the bottom of the pyramid. And so we can do this by being prudential and aligned to international good practices before the regulator starts being very worried and potentially concerned about the sector.
Thank you very much for that, Lucia. So we are just about perfectly on time, and I don't see any other questions from the Q&A. So I think that is probably a good note to end it on. I want to say first, thank you very much to Lucia for all of the work you put into this brief and for presenting it here today. Thank you very much, Brian, for being willing to join us and speak a little bit about your experience and your perspectives on this from the investor side. And also thank you to all of our attendees for joining, and we hope it was very informative and useful for you in your work. You can see a link in the chat that we provided to the brief itself. You can also go to our website, the PAYGo Perform website at FinDev, where you can find the full accounting brief. We will also post this webinar recording and share the slides with you afterwards. And you can also find all of the resources that we've put out there for the PAYGo Perform KPIs themselves. So that's the technical guide, some quick reference guide and tools to actually use the KPIs and some supporting materials along with those. So we definitely encourage all of you to go to the Perform website at FinDev, take a look at those tools and take a look at this accounting brief, which we've recently posted there. Thank you again to everyone, and hope you have a great rest of the day and a great rest of your week.